Remember,
Yeah, yeah.
discretionary is the three A's, making decisions about the three A's, which is the asset, the amount, and the action, buy or sell, right?
Mm,
Time and price is not discretion. And so
mm,
remember, discretionary trading is a limited power of attorney, right? So a limited
mm,
power of attorney, which is specifically with one one representative. If a representative that has discretionary authority leaves that broker dealer, then there's no more discretionary authority. It can't be transferred to another person.
okay.
Okay. Now, you know the difference between regular way settlement, right? Which is now T plus one for everything, right?
Yeah, yeah,
And everything settles T plus one. Okay.
yeah.
And for the ex dividend date now, the
Mm,
with regular way settlement, the regular way settlement, the ex dividend date is the same date as the record date,
mm,
which makes
okay.
sense because your trading is T plus one. So if you were to buy the stock one day before the record date, since it's T plus one, you would settle on the record date and be an owner of record. If you bought it on the record date, then it would be settled what? The day after the ex dividend date,
Mm,
or sorry, the day after the record date. So
yeah.
the ex dividend date is always the same day as the record date with regular way settlement because it's all T plus one. And because it's so simple, it's the same date, then you're not going to really get any more questions. They used to ask questions before when it was T plus two, but now they don't. And so we don't have to worry about it. Okay.
Okay.
All right. You know how to calculate yield?
Yeah, it's that chart where it's like,
No, that's something different, but we'll get to
oh,
that. Okay. So we have nominal yield, current yield, yield to maturity, yield to call. Okay. Now
okay.
your nominal yield is the interest rate that the bond produces if you bought it at par. So if it's a 5% bond, it's going to pay $50 a year in interest, no matter what you buy or sell it for in the secondary market. But the yield is really the real interest rate that you're getting because that takes into account the price you paid for it. Yield to
Mm,
maturity is reflecting what you're going to earn between now and when the bond matures, or yield to call reflects what you're going to make between now and when the bond is likely to be called. So this is the big X that you
mm,
just talked about. And
yeah,
this is
yeah.
one of the two things that I always have my students draw on their paper, and it helps you remember the order of the payout. So if you bought the stock at a if you bought the bond at a premium, the nominal interest rate is going to be the highest. The yield to call will be the lowest. If you bought it at a discount, it would be the opposite. The nominal will be the lowest, and yield to call will be the highest. And so when you draw the chart, it's the big X. Remember to put the straight line across for the par, and then you put the
Mm,
vertical lines. And remember, the order is YMCA. Y for yield, M for yield to maturity, C for yield to call, right? So YMCA in that order. And then if you already get a question like this, if the bond is trading at a premium, which of the following rates is correctly ranked from high to low, right? Well,
yeah.
if you bought it at a premium, I just got through saying from high to low, the highest is going to be the what?
Yeah.
The nominal yield or the coupon rate, right? And remember, they'll switch them on you because
Mm,
A says coupon and D says nominal. So that means it's either A or D because we know that's the
mm,
highest. But the lowest is going to be the what? Not the coupon rate. The coupon rate's the same thing as the nominal yield. It's going to be A.
oh,
It's going to be the yield to
yeah,
call, right?
yeah.
But you can get questions like that, and it's really hard to remember that. But if you draw the chart, it's just pointing, right?
Yeah. Yeah.
Okay. And then calculating the yield. So this is either the bond yield or the dividend yield. And it is the annual income in dollars. And that's the trick. You got to get the annual income in dollars divided by the market price. Okay. But
Mm,
remember, you got to get it in annual dollars. So if they give you dividends and they only give you one dividend payment, then you got to multiply times 4. If they give you a
mm,
bond, you got to multiply times 2 for the semi-annual. But then after you get into annual income, it's the what? The little number divided by the big number. So, for example, if the question says a bondholder, caught up? Can you go back?
Yeah. 1 second.
No problem. This
the
is
bond paid
this is
for
slide 42
extended-
in the day 3 material, by the way. So you'll make a reference.
Okay.
So slide 42 in day 3.
Thank you.
So you got to get the money into annual income. So it's the annual income in dollars divided by the current market price. Little number divided by the big number. Okay. So the question might say a bondholder received the payment of interest from a premium bond of $2,500 if for $25. If the current market price is $1,250, what would the yield be for the buyer of this bond? Okay. Well, remember, you've got one bond payment, so you got to turn it into annual income, which means 25 times 2.
Mhm.
And
4%.
then you divide the little number by the big number, and that gives you 4%.
Perfect. Okay. Okay, perfect. Thank you.
All right.
That makes sense. Mm-hmm.
Now, to figure out your percent of gain, it's really simple, right?